Let's say we've come to our charts at the start of the day and we are eager to find some trading opportunities. We are on the Swiss franc daily looking for the perfect market state for our strategy. Remember that the beginner strategy focuses on volatile ranging markets, not trends. On this chart we see highs and then lower highs. And if we connect those highs and draw the line, we have a trend line. But at the same time, we need to notice that prices are making lows and lower lows. Also, the trend has the ability to change its angle. As the volatility in the market changes, the angle of the trend also has that same ability. But as long as the trend line is intact and respected, we assume that the trend is still in play until there's a trend line break. Now it's at this point where the market state could change, and it could change to the state that we would love to trade in, and that is the accumulation stage or the ranging stage. Let's see what happens. But first we need another qualifier. As soon as there is a trend line break, we need to see one of two things. We need to see a failure to follow through, or we need to see a rat trap which is qualified by the RSI. So one of these two patterns we need to see. This is the failure to follow through, meaning that the price on top here was unable to push lower and take out the lows in this area. And the second scenario is prices comes down and up, and it creates a rat trap or a bear trap in this instance, which is qualified by the RSI. Let's see what happens in this scenario. We have our trend line break, and then soon after there is a lower low. Now, is this a rat trap that's qualified? We don't know. What we need is an RSI indicator, and this is going to help us decide whether this is a qualified rat trap or not. And yes, this one is. You have your lows and prices are making lower lows, and the RSI has its low, but it's unable to make a lower low. The RSI is actually pushing higher, so it's pushing into the opposite direction of what price is. So this is the RSI diverged. So what we have now, we have our trend line break, which is just here, and then we have one of these scenarios in place. We have our rat trap in place. So it's at this point that we can draw our playing field, because if prices breaks through this level and creates higher highs, then we are back in a long trend. The trend has changed from short to long. And if prices decides to come down and break this level and create lower lows, then it's a continuation of this trend. But what we want with the beginner strategy is we would like to see prices inside this area. And the area, the playing field in which we are going to trade, needs to be at least 100 pips in width. This one is 244 pips. So this is the perfect market state. So if prices proves to stay inside this range, we can trade it. So here we have a clue. Is prices going to make any highs higher than this, or will prices stay inside this range? If prices comes down and touches this level here, then anything after that we can trade inside the range, because then we are in a qualified range. But let's see what happens. Prices are making highs and higher lows. No, this is the incorrect market state. We are in a proven change of trend now. So we do not trade the beginner strategy inside this trend. There we go. we have a trend line that has changed its angle due to the changes in the volatility of the market. But as long as prices stays above a trend line, we do not trade inside, or we do not trade the trend with the strategy until we see the trend line break, as we did before, and also the other. There we go, we have a trend line break. And as soon as we see a trend line break, we need to either see a failure to follow through, which is there. Prices are failing to go higher than this because we do have a trend, but it's failing to follow through. This is the high that needs to be taken out. And then we also have a low that needs to be taken out, but prices are changing. So we have a qualified area in which to trade right here. All we need to do now is to qualify the playing field. That is to check whether we have at least a 100 pip between the barriers, and we have 114 pips, so that's fine. So what we do now is we introduce our envelopes, and this would help us with our strategy on the 15-minute later. But let me show you the envelope. So each time prices touches the barrier, and at the same time we have an extension of price beyond the envelope, then we have an opportunity on the 15-minute to trade. There's one opportunity, and that one would have worked out because it comes down and touches the bottom. And then another opportunity, that's opportunity number 2, and it touches the bottom. And then the third opportunity, or the fourth opportunity, prices hits there, and then it comes all the way down. So in this example here, if we had traded and waited for the perfect market state, we would have had our first opportunity there, 1, 2, 3, 4, and 5 trading opportunities.